Last night, Trump gave the speech.
Thanks to the progress we've made, I can say tonight that we are on track to complete all of America's military objectives shortly. We're going to hit them extremely hard over the next 2 to 3 weeks.
Today, the market translated it into numbers.
Let's talk about oil and gas jumping after President Trump, in his address to the nation, signaled an escalation to the war in Iran.
The dollar rose, Treasury yields rose, US futures fell, and tomorrow morning the biggest economic number of the week lands while the stock market is closed. That is the land we are navigating before us, and for me it's enough to keep my stance exactly the same it's been for the last 6 weeks. That is patient and holding a large percentage of my portfolio in cash. So in this episode, I'm going to look at the 3 things that are sitting right in front of us, explain them in plain English, and show you why they keep me in a wait and see mode for a little longer. Welcome to the Liam Hyland Portfolio. I'm Liam, a chartered accountant documenting the build of a real stock portfolio in public. This is not financial advice. This is just my own analysis of the market and the positions I hold. So, first is oil. What we're looking at here is one of those core prices underneath the whole global economy. When oil moves sharply, it is not just an energy sector story. It is a transport story, a shipping story, a manufacturing story, an inflation story, and, as we all know, eventually a consumer story. The reason it matters is simple. When energy gets more expensive, a lot of other things in the world become more expensive with it. To measure this, we look at global oil price called Brent crude, and today it rose 7.6% after Trump said a tax on Iran would continue over the next few weeks. Given the increase, the market immediately started to recalculate things. Will inflation stay higher, and for how long? Will consumers get squeezed? Will input costs rise? Will central banks become less relaxed? That is why a move like this changes the mood so quickly in the market. It is one number, but it pushes on a lot of doors at the same time. And you actually can see that in how the market reacted today. Then there is also the return investors' demand to lend money to the US government. It tells us whether markets think inflation and interest rates are going to stay higher. If those returns rise, the market becomes less willing to pay premium prices for future profits. These returns are called Treasury yields. And guess what? They moved higher just like oil did. And investors reassess the inflation outlook after the speech. So takeaway number 1 is very straightforward. Market uncertainty has continued to rise, and I continue to build up my cash position as a result. This is not me trying to sound profound. It is basically the investing equivalent of not overtaking into the fog. Second is cost pressure. What we're going to look at here is the monthly check-in with people who actually run US factories, because they get an early read on whether orders are rising, deliveries are slowing, and costs are getting worse. These factory managers sit right in the middle of the real economy. If they start saying things like, yeah, things are getting more expensive and harder to get, that is usually a useful early warning sign. The report that covers this is called the ISM Manufacturing Report. One of the most useful parts of it asks a very ordinary question. Are you paying more for the things you need? This week, that prices paid measure jumped to 78.3, the highest since June of 2022, and supplier deliveries have slowed. So factories are telling us their costs are rising and getting stuff delivered is taking longer. So if businesses are paying more for energy, parts, materials, and shipping, that pressure tends to end up somewhere. And usually it's in the profits or the customers get hit. Usually both, but more likely the customers. So not only do we have oil prices jumping because of last night's speech, we also have the signs that costs in the real economy were already becoming less cooperative anyway. So then that leads us to the next obvious question, which is why as investors would we care about this? I mean, why does the stock market care about these macro events anyway? Shouldn't we just find great businesses and buy and hold? And yes, well, that's indeed true that what we really care about as investors is the fundamentals of the business and its performance. The way we value that business is entirely dependent on a little thing called interest rates. And now the US central bank controls interest rates, and interest rates change the cost of money across the economy. Lower rates help stocks, while higher for longer rates make the market more demanding, especially towards expensive growth companies. The US central bank, the Federal Reserve, or just the Fed, and reporters tied this week's rise in oil and factory cost pressure to fears that inflation could stay elevated and keep the Fed cautious, i.e., no rate cuts. So the second takeaway is this: the path to cheaper borrowing and easy capital just got worse. Again, I don't feel any special need to accelerate into buying things in a market like this. I will continue to build my cash. And then that brings me to the third thing, which is timing. What we're looking at here is the main monthly snapshot of the US labor market, because jobs tell us whether the economy still has momentum or whether it is starting to slow down. It's a constant balancing act trying to figure out if growth is holding up, and because of that, what does that mean for interest rates? Now, there's an official report the market uses as the main scorecard for that. It is called the Employment Situation Report, though most people just call it non-farm payrolls or the jobs report. The Bureau of Labor Statistics has told us the March report is due at 8:30 a.m. Eastern on Friday, April 3rd. So as an investor, when it comes to analyzing information like this, we not only have the information itself, we also have when it gets delivered to us, and we also have when we can act on it. Which is why what we're looking at next is the market calendar, because timing changes how information gets absorbed. If a major economic lands while the stock market is closed, investors get the data first, then they get all the news headlines, then they have the weekend, and only after that do they get a full chance to act in the stock market. That can make the whole thing feel more fragile. The New York Stock Exchange holiday calendar clearly shows that the market is closed on Friday, April 3rd for Good Friday. And the jobs number itself is not landing into a calm market either. That estimate comes from ADP, the payroll company, which reported 62,000 private sector jobs added in March, with expectation for Friday's official payrolls report to show around 60,000 jobs added, with unemployment at 4.4%. So what does that mean for investors? Well, if the jobs number comes in stronger than expected, the market can effectively say that, well, maybe the economy is still running hot enough that the Fed has less reason to cut interest rates, especially with oil already high. If, however, it comes in weaker, the market can say, well, right, maybe growth is softening into a more inflationary backdrop. Now, neither of those interpretations is especially good. And so that is my third and final takeaway. We just don't know what will happen with that report tomorrow. So buying stocks now, even as they dip, I'm just not interested in rushing into that given this timing. So where does that leave me and my portfolio? Well, it's pretty much in the same place I've been for the past 6 weeks. I'm still watching the same quality holdings I have. I'm still interested in long-term compounders. I'm still happy to buy great businesses. I just want the combination of price and backdrop to make a bit more sense than it does today. Because right now, what we have in front of us is not one random red flag. Oil is higher, cost pressure is higher, yields are higher, jobs report is coming out tomorrow, market is closed tomorrow. Any one of those on its own is perhaps manageable. All of them together make patience look like the right move. And that is my broader point. A lower stock price and a better buying opportunity are not automatically the same thing. Sometimes the market is offering us true value. Sometimes it is offering us a problem that has not finished unfolding yet. And my job with my own money is to make sensible decisions with imperfect information, which isn't always that exciting. So as of today, Thursday, the 2nd of April, my stance is still the same. Last night, Trump spoke. Today, the market repriced that speech through oils, yields, and futures. Tomorrow, the jobs report lands while the stock market is closed. That sequence is enough for me to stay patient. I'll watch the number tomorrow. I'll watch how the market sets up for Monday. And if the picture improves, I'll act. But for now, waiting still looks like the better trade. Thank you.